Good morning from London. I'm Kriti Gupta alongside Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Tensions remain between the world's two largest economies as Beijing urges local companies to avoid using Nvidia's H20 processors. Meanwhile, the United States and China agreeing to another 90-day trade truce extension. And Donald Trump downplays expectations for his upcoming meeting with Vladimir Putin, casting it as a, quote, feel-out meeting, saying he would confer with Ukrainian and European leaders after the sit-down. Plus, a focus on the data. Traders look to the U.S. inflation print for signs of a tariff read-through. Meanwhile, U.K. jobs data breaking across the terminal. We'll break down the numbers in just a few moments. Val.
Happy CPI Day to all those who are celebrating. We are seeing U.S. futures treading water this morning. Continued outperformance when it comes to European futures. Euro Stoxx 50 up nearly 0.4%. This optimism around a possible ceasefire between Ukraine and Russia still on the table. Euro dollar not doing very much this morning at 116.20. And U.S. 10-year yields keep creeping higher, but we are just slightly softer today at 4.27 for the U.S. 10-year. The countdown to the opening trade starts right now.
Tuesday the 12th, good morning. Day to day, as Valerie's already indicated, big number coming out of the United States. Some decent data coming out of the UK as well. We'll get to that in just a moment. By the sounds of things, Valerie wants me to send her a card for this particular anniversary. The latest CPI data dropping. It's a card for everything these days. Let's talk a little bit about what we are watching in terms of the data coming out of the UK. I'm going to start actually with the earnings numbers because I think they're quite interesting in terms of the way they relate back to spending in the UK at the moment. Average weekly earnings, 3-month year-on-year, coming through at 4.6. That's a drop down from 5. The weekly earnings ex bonuses look pretty much in line with estimates, but there is clearly a wage factor that is beginning to come into the UK market that we need to be aware of. That may be showing up in the BRC data, which we saw overnight, which is certainly showing a slowing in spending. We'll see whether that shows up in the retail data as well in the United States later on this week. In terms of the employment rate and what we are watching there, looks pretty much in line with estimates. The ILO number coming through at 4.7. The employment rate change actually looks a little bit better than anticipated. The claimant count rate softening up a little bit. I'm not sure there's much to see here in terms of the overall numbers. What we do know is that actually there is a tax factor coming into the UK labour market, which is showing up in the numbers and will continue to show up in the numbers as we approach the budget in October. But, Kriti, that's the UK number. And again, I think it doesn't really change a difficult decision that is being made on a meeting-by-meeting basis by the MPC over at the Bank of England. The Fed's got some difficult decisions coming up as well, and we're going to get a lot of information today on the CPI number.
Absolutely. The Federal Reserve stuck between a rock and a hard place. The CPI print here, the expectation is about 2.8% on a year-over-year basis, 0.3% on a month-over-month basis, which is slightly, emphasis on slightly, higher than what it was in the prior reading as well. But this is really where it's crucial because you're starting to see, or at least hoping to see, for the folks that want some sort of hawkish tone from Jay Powell and his peers, some sort of tariff read-through. Do we see that, though? Because it's been a couple of months, and we haven't really seen it just yet. That being said, is it going to show up? But also the labor side is showing the cracks. So the argument that Donald Trump and his colleagues are making that maybe Jay Powell is late to the game yet again, the data is starting to tilt in that direction.
Well, look, we could get a few narratives coming out of this print. We know that last month we had tariff-induced inflation when it came to apparel, appliances, furniture. If we see that decline today or fail to rise, that goes straight in the hands of the doves, saying that tariffs are a one-off price impact. But if we see this continued price rise in things like furniture and audio equipment, maybe that'll feed into the hawks, saying that this is a persistent inflation problem. They're worried about moving into things like core services.
Okay, let's have some fun with this. You get a 3% core number. Do you take 50 off the table? Do you fade that 50 move that people have been talking? There were 2 people on the show yesterday talking about 50 basis point cuts coming from the Fed. Do you keep the 25? Does 25 change on the back of a 3% core? How does the market price this? Would today's number, if it was 3%, 3.1%, let's go the other way and push it in the direction of the hawks. Do you take 25 off? What would it take to take 25 off the table?
Look, I think it's more than just the core CPI figure. It's going to be about what drove that. And if we're starting to see a pickup in inflation in core services, which people aren't expecting right now, that could be something that could take September off the table. If we start to see inflation broaden across the core goods basket to maybe things that aren't directly related to tariffs, that could also be something that could tempt this September hold instead of a September rate reduction.
But it could also have a net effect in that if you start to see a pull down or even an increase as a tariff read-through as well, they can counter with the lower energy prices as well. And that's just simply this idea of if you see higher tariffs, the growth slows down, then oil prices come down. And the result is net zero. I think that's the best case scenario, perhaps. But that brings us nicely to some of the other trade tensions we're watching around the world, which is going to feed into this entire risk narrative.
Yeah, we got a confirmation that this China trade truce has been extended for another 90 days. It takes us basically until mid-November. The key thing about that is there is this, again, talked about meeting between President Xi and President Trump at the APEC summit in October. So that would well fall in within this extended trade truce of 90 days. We know that the U.S. still wants these agricultural products bought. Soybeans was a topic on Trump's minds yesterday. And then when it comes to China, they want that 20% fentanyl tariff reduced. But it does seem like that this China trade situation is really moving into a new sphere here. We did have news from China that they've been urging firms not to use the Nvidia H20 chip. And we know that these chip restrictions are a big part of these trade negotiations.
I'm going to kind of basically put my Ed Ludlow cap on now because he was talking to me about this first thing this morning. I think the story here basically is that everybody was expecting Nvidia to be able to book chip H20 sales into China.
Because they got the license on Friday.
And now you can't do that. So you have to back that out. I still don't understand how this tax would work, but we'll get to Ed a little bit later on and maybe he can explain it to us. But basically, you back that out. That's why you've had the move this morning, I think, in S&P futures, which have turned negative. So it seems as if the situation we're in is that the China trade truce is positive, but the H20 news is negative.
In some way, China is looking at backing up its domestic industry. Yeah. So we're seeing things like Chinese... and maybe perhaps they want access to this better chip, which Trump talked about yesterday. He said he was open to selling a scaled-back Blackwell chip. Yeah. Blackwell is NVIDIA's most advanced AI chip. The H20 is basically a hamburger compared to the steak, as Dan Curtis was talking to me about earlier. But this could be a move by China to protect their domestic industries, and that could infiltrate into other topics.
And you got Huawei, who are producing chips, and maybe that's the way they want to push as well. So maybe the danger from the US point of view is that this does do what Jensen Huang has talked about, which is accelerates the Chinese industry to be able to produce actually comparable products. Now, we're not there yet, and we're a long way away from there being from that, but it's going to be interesting to watch. I want to bring up, let's talk about the meeting coming up on Friday and what is happening on the geopolitical front between the United States, Russia, Ukraine. Let's bring up the Rheinmetall chart, because I think this is really instructive in terms of how the market is perceiving this narrative. And let's look at it through the market kind of lens. Stock got sold off on Friday. You can see that move. That's on the back of the expectation that we are going to see this summit potentially producing some sort of a deal coming through and some sort of a peace deal. Rheinmetall drops on that. Doesn't move much yesterday. But if Trump is signalling actually that he's not so convinced that this is going to produce a deal, do you buy Rheinmetall this morning? Is that the trade you do on the back of this? Do the defence stocks out of Europe pop on the back of a couple of tough days? Now, some of those are results-driven, but you can see what's been happening on a one-week basis for these defence stocks. If Trump's sounding more cautious on this summit, what happens to those at the open this morning?
Well, today's trade, to your point, is a great test of our theory yesterday, which is this idea of how much of the pullout or the unwind that you're seeing in defense stocks is actually related to Ukraine, or is just an unwind of the European kind of American exceptionalism, European alternative kind of story, or simply a valuation story. Rheinmetall, these defense names are still some of the juiciest, or running at the juiciest multiples in the world at the moment. So how much of this is actually related to a potential ceasefire, or do we just go through this exercise, take some momentum out of the stock, and then restart down the road?
And we do have some more potential catalysts before the big meeting in Alaska on Friday. We know that the EU is looking to hold a call with Trump tomorrow at 3 p.m. Berlin. Well, they'll be pushing their interests, such as security guarantees for Ukraine, and such as pushing back on Ukraine ceding any territory. We know that territory is likely to be a big sticking point at the talks on Friday in Alaska.
It's very polite of Trump to have that call. and to listen to the Europeans.
No invitation, just a call.
Is he going to hear what they say? Is he just going to? I don't know. But I'd be interested to see what kind of impact he has. There's also an indication that he's going to brief afterwards as well. Zelensky's not going. Maybe there's a meeting further down the road. At the moment, I think we just focus on Friday. If Trump is downgrading expectations, I think that is quite interesting. If this doesn't go anywhere, there's a ripple into oil prices. There's a ripple into other factors as well that you need to be aware of. Let's talk about what we're going to be talking about on this show over the next couple of hours. We've got some great topics to discuss, and we've got some great guests to discuss them with. Florian Iepo is going to be joining us in Lombard Odier. He's the head of macro. He's got a whole theory on what the CPI number is going to be telling us today and whether or not we should be thinking about 25, 50 or nothing at all come September. Ke Jin, LSE professor and author of the New China Playbook, will be joining us a little bit later to talk about the truce and the chips and all of that good stuff. Lucy Baldwin, City Head of Research, is going to be joining us, as will Grace Peters, JP Morgan Private Bank Co-Head of Global Investment Strategy. Val.
And let's look at what we have on the docket today in terms of data. The German ZEW print drops this morning around 9 a.m. UK time. We also have U.S. CPI later. That is the big highlight of the week, of the month, arguably. We also hear from Fed speakers, which could be interesting. Will they comment directly on any of the surprises we get in that CPI report? And then also later today, we will be Kriti.
Absolutely. Lots going on in the Fed speak, lots going on in the data speak, and there's plenty of geopolitics, Guy, that we have to pay attention to as well.
Let's work our way through what else we need to know this Tuesday morning. Norway's 1.9 trillion sovereign wealth fund has divested from 11 Israeli companies and is terminating all contracts with external managers in Israel. The decision follows public outcry over investments linked to the war in Gaza. The fund held stocks in some 61 Israeli companies as of the end of June. There is currently a press conference, a briefing taking place with the Norwegian sovereign wealth fund. We may tap into that a little bit later on. President Trump says he's taking over Washington, D.C.'s police department and deploying 800 members of the National Guard to crack down on what he calls out-of-control crime. D.C.'s mayor called the move, quote, unsettling and unprecedented, but she said she had little legal recourse to challenge it. And staying at the White House, President Trump has named E.J. Antoni, chief economist of the conservative Heritage Foundation, to lead the Bureau of Labour Statistics after firing the agency's head earlier this month. Antoni has been vocal about his concerns over the BLS jobs data and the revisions that we have so recently seen. The position is, of course, subject to Senate confirmation, which will be interesting. You've also got the Fed. Talking of Senate confirmation, Stephen Mirren's going to be facing that. Is he going to be there for? He's being nominated into the Kugler spot. Is he going to be there for the September meeting? I think it's going to be really interesting.
Highly unlikely, given that the summer recess, they don't come back until like the 2nd of September. So it would be setting a world record for how quickly that confirmation would get through. But the Fed chat is interesting in terms of yesterday. We've heard that it's now reached a wider bucket of contenders, and it seems like now for the Fed chair, or perhaps for replacing this Kugler seat after he steps down in January.
I think we need a list of who's not on the kind of not being considered. I think probably at this point. And that is the Treasury Secretary, as far as I can tell. Everybody else is on the list right now.
Well, it seems like many Fed voters are on the list, which could perhaps sway their votes in the upcoming decisions.
Well, some of those folks that are on the screen right now, I mean, Kevin Warsh has been in the running for a while. He's the one that Jay Powell took over in the last iteration. Michelle Bowman is on that list. She was the hawk, or is, I would say, the hawk for a little bit.
But I think the point that Valerie makes is really interesting there, is that if you put everybody on the list and they all want the gig, do they fall in line with the Trump view? Do the hawks become less hawkish as a result of maybe being on the potential list for Fed chair? It's quite a cunning move.
And you have to think about they're going to be having these interviews for months. I mean, they potentially don't need to name a chair until maybe March of next year to get the confirmation done by May. That's when Powell ends his term. So this could be a month-long apprentice type saga laying out in front of us.
Wow, so March of 2026.
Exactly.
Wow, that's what?
But just keep everybody
like 9 months away.
Keep everybody guessing until then. Take their hawkish tendencies. If you take the right side risk off the table in terms of kind of the hawkish tendencies that some of these members have, make them more centrist, make them more sort of approachable, then it's really interesting to see how that would change the vote story.
That could arguably be more useful to Trump than having a shadow Fed chair that everybody watches. Just keep everybody in the running and everyone trying to impress him and get their name in front of him. That could arguably work to his interests more than the shadow Fed chair idea.
A little bit of evidence of that in Kevin Hassan and Chris Waller as well. Let's just hope that the Fed chairs or potential Fed chairs are watching the data. And as data dependent, as Jay Powell suggests, coming up on the program, defense stocks could move again after Donald Trump downplayed expectations from his meeting with Vladimir Putin. We'll test that theory at the open. Plus, Beijing issues new guidance banning the use of Nvidia's H20 chips as the sector continues to move to the center of the trade war. Up next, right back to the markets, though. Lots of data to look ahead to today, especially that inflation print. Does it change the narrative? Do we see a tariff read-through? If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Welcome back to the opening trade. It is CPI day. The biggest data print of the week drops at 1:30 p.m. UK time. Let's take you through what the market is expecting. When it does come to core CPI, we are expecting a slight tick up in the monthly reading. Last month, we got a soft reading of 0.2, came in softer than expected. We're now expecting a tick up to 0.3%. And I think this is really going to be where the drama is going to be, because it's not only about core CPI, but what has led the surprise in core CPI. If it surprises on the hot side or the cool side. The market will also be watching for this various components of tariff-induced inflation. Last time around in the previous reading, these were the four components that showed a decent amount of tariff-induced inflation. Now, market will be also parsing through to whether these components see continued rise in inflation, or perhaps that was just a one-off, and that play into the hands of the doves at the FOMC, that tariffs are a one-off price increase and they're not going to continue to increase as the years and as the months go on into the end of the year. That being said, the other key thing to watch is just the handoff in between core goods and core services. We know that core goods has been rising in terms of inflation since the middle of last year. Core services has kept its disinflationary track on track for quite a while. If this narrative does flip around, that could cause a headache for the Federal Reserve. If we get an uptick in core services inflation, that could really cause some concern when it comes to those Fed cuts that are priced in through the end of the year. Guy.
Well, plenty of questions. Let's try and get some answers or some expectations on what we are going to see in the data a little bit later on today. Florian Ielpo, head of macro over at Lombard Odier Investment Managers, joining us now. Florian, great to have you on the show. Do we get an answer to the question that we've all been asking for months now in this data? When does the tariff effect start to show up? Is it this time around, or do we need to keep waiting?
That's pretty much the challenge for this inflation print, in my opinion. You're right. 2025 is coming with a riddle, and that riddle is how come that 15% average tariffs have no impact on the U.S. economy, either in terms of growth, in terms of inflation, in terms of earnings, because the earnings season has been quite spectacular, right? So the way we see it is there is a batch of soft data at the moment, which is pointing to higher inflation prints right now at this publication. Currently, when we look at the data in our nowcasting signals, which was what we are seeing, is 55% of data indicative of an inflation surge in the U.S. It's the highest across the G10 world that we are contemplating, and this normally should bring about an increase, potentially even so, a positive inflation surprise in the print. Now, as you've mentioned, these could be mitigated by slower service inflation, which will make the life of the Fed even more difficult. Now, why is this number important? Because if we see a positive surprise, then that would be indicative that finally, we see those tariffs impacting the U.S. economy, and that could have like a long list of potential consequences.
Florian, it's Kriti in London. When we talk about that tariff read-through, how likely is it that this print is ultimately shifted to the side as simply one data print and not indicative of a broader trend?
I think, like you mentioned a few minutes before, the notion of contagion from a surge in the price of goods to a continuous increase in the price of services would be the one thing that would create a self-sustained dynamics in inflation. We're far from being there yet, and honestly, I don't think that's where we should be looking at. What we should be looking at is basically the potential for this inflation surge to hit demand in the U.S. at a time when, well, basically the Treasury is spending less to stimulate the economy. So the slowing impact of this inflation print is probably much more important than the inflationary trend that would worry, of course, the U.S. Central Bank.
Florian, we're currently pricing around a 90% chance of a September rate cut when it comes to the Federal Reserve. Is there anything in this print today that could tempt that to be a Fed on hold or a Fed cutting 50 basis points? What's your thought on that?
That's pretty much the last decisive data point, I think, after the large negative revision in the employment numbers from the previous payroll reports. Now. This is, again, we're coming at the moment at the juncture because a lot of the lack of impacts on inflation from the tariffs comes from the mechanics of stocks of inventories. A lot of manufacturing companies in the U.S. have been able to restock, to replenish their inventories during the first quarter, and normally these inventories have their own life cycle. And we should come precisely now in July, for the print of July, of the month of July, at the point where we should start seeing, well, these higher tariffs being channeled through the dynamics of inflation. Yep. It's even more to the case as retail sellers actually have failed to replenish their inventories at the beginning of the announcement of the tariffs. So basically, the top part of the production chain is actually quite high on stocks, were quite high on stocks, and now is depleting stocks. And this will be channeled into an economy with very low stocks on the retailer side. So you see, this moment is probably the moment when you can see inflation ticking up, yep. And that will make the Fed think twice.
Okay, there's a debate that's kind of been going on around this table over the last few days, Florian. If the US economy is slowing, doesn't that take inflation off the table? Doesn't that reduce the risk of inflation? Can you have inflation in a slowing economy? Is that something that the US is heading towards, or is that just not possible in your mind?
Well, it's called stagflation. It's a perfectly reasonable scenario, but as I guess it's been mentioned in your debate, it's a transient regime. It's a temporary regime. It's not a regime in which you can stay for long, because demand destruction eventually leads to lower inflation. But the life cycle of inflation and the life cycle of growth can differ for a few quarters, which will make that the Fed will have to make a decision between, in a context of rising inflation forecast, as we'll probably discover in September, and slower growth. They will have to make a decision between the two. If history can be of any usefulness at this point, it happened. Yep. Something similar happened in 2007, and the Fed made the decision of growth versus inflation.
Yeah, and we all know how that turned out. Florian, great to catch up. Florian Ielpo, head of macro at Lombard Odier Investment Managers. Thank you very much indeed. That's the debate now, isn't it? Can you have stagflation if it lasts? How long could it last? Will the Fed look through it? The inflationary impulse? Does today's number matter? Lots of things to debate.
Lots of things to debate. You didn't even mention all the geopolitics. That's what we're going to dive into next, as China urges local companies to avoid using Nvidia's H20 processors. We're going to dive into the decision behind that announcement. Stick with us. This is Bloomberg. Minutes away from the start of the opening trade, the futures picture is looking fairly positive. Your outperformer, at least according to the futures indication, is over in France. CAC 40 futures higher by about 0.4%. I am still looking at the Amsterdam futures as well, because they're higher by 0.2%. But I'm curious how much of the tech story, the chip story, ends up showing up in the likes of ASML and others, and ultimately into Amsterdam.
Yeah, definitely dragging on NASDAQ futures at the moment. Let's check on the fixed income open in Europe, and not a lot of action. German 10-year yields are holding steady around 270. Also, treasuries basically unchanged as well. So fixed income is not the, I guess, focus of today. Maybe we're focused a bit more on tech stocks and the impact from this Nvidia.
Give it time. We'll get to that CPI number a little bit later on.
Patience, Val.
The bond market will be
it'll come back to life.
It'll be awake later. Don't you worry. I want to take you to Norway, actually, because the Norwegian Sovereign Wealth Fund is currently briefing. Great shot behind the tables. What we've learned so far is that in the first half it made 5.7%. That was the return. Nicholas Tangen is briefing now. He's saying no plans to step down as CEO. He's basically saying as well, the panel have been indicating they will continue to sell Israeli holdings as well, which has been the news that we've seen overnight. It's interesting in terms of how that narrative is going to play out and ultimately where it takes this fund. But we will continue to follow it. If you want to follow it as well, I think it's in Norwegian. I actually don't know where they're briefing from as well. You can do so. It's on LiveGo. Go to your Bloomberg terminal. LiveGo is the function, and you'll be able to follow along and listen to this, obviously live. But I would urge you maybe to stay with us. That's kind of what we're here for. So stick around. We've got plenty more still to come, and we'll continue to keep you updated on that as well. Let's talk about what China's doing, because that certainly has been moving markets this morning, as we've already indicated. It is urging local companies to avoid using Nvidia's H20 processors, particularly for government-related purposes. The move comes, of course, as President Trump signed an executive order extending the US tariff truce with China for 90 days. Let's talk more about this with Jill Desis, who joins us on this story. Jill, let's start with chips. What's the thinking behind China's move? What are they signalling by saying basically don't use the H20? Are they saying there's better Blackwells coming, or actually Huawei's got a better product, or is this part of the bigger geopolitical narrative?
I mean, at this point, Guy, I think kind of tough to know, but at least in the way that it seems that China's describing this, it does seem to be based around those government concerns, national security concerns. It would point out that the guidance as we know it is particularly strong, again, for government-affiliated, agencies and such to not use these H20 chips. Remember, I mean, these were specifically designed by Nvidia to try to market to China because these were lower tech chips. I mean, in this sense, it does kind of, remind me a little bit of, similar guidance that the Chinese government has given out in the past for example, Tesla vehicles. It wasn't too long ago that they actually did, try to prevent or discourage, government employees from using Tesla vehicles ostensibly for national security concerns. But, I think at this point, obviously the big takeaway here is that this is a pretty significant complicating factor in some of the recent news that we've heard just around how exactly, U.S.-China trade negotiations are ultimately looking. Obviously, we've got that 90-day extension on that U.S.-China truce, but alongside that, we had also heard from companies like Nvidia, like AMD, which I would point out also seems to be affected by this latest guidance from China about how they were going to be picking up a portion of the export tax, in terms of shipping chips to China. So I think it does kind of put a wrinkle in some of those plans, at least one if you're a company like Nvidia or AMD, or also two, I think maybe opens up some questions about what the U.S.-China relationship looks like going forward.
Jill, when it comes to the U.S.-China trade negotiations, yes, we got that truce extension, but is there any further color about what might become a sticking point in the next round of negotiations?
Yeah, I actually think that there's a few things that are, potentially some pretty significant sticking points here. I mean, first of all, this does kind of just kick things down the road for now. It's really now about mid-November that this truce extends things to. Maybe that gives us some time for a Trump-Xi meeting, but on the table right now, maybe there's some more open questions about increased agriculture purchases. Trump seems to be a little bit fixated on that with the potential for soybean purchases. Obviously, this chip story isn't going away. I think that potentially enters the room for negotiations here. And then one big question I have, I mean, China is a significant buyer of Russian oil, and we've seen how much that has really sort of vexed Trump over the relationship that the U.S. has with India. I mean, that's been a pretty central component of pushing tariffs that the U.S. has on Indian exports pretty high there. So I wonder, how much that ultimately enters the calculus, particularly as we await this Trump-Putin meeting. We don't have like a significant end for Ukraine ceasefire yet. So I think there's a lot that can kind of unfold within the next 90 days when it comes to this.
Bloomberg's Jill Deese is walking us through some of those sticking points and touch points between the U.S. and China. We thank you so much. Let's expand the conversation, perhaps answer some of the questions that Jill just posed. Ku Jin, global economist and professor of finance over at the London School of Economics and author of The China Playbook, joins the program this morning. Ku, a pleasure to have you. Thank you so much for your time this morning. You're the author of a book called The China Playbook. What is the Chinese playbook right now with this 90-day extension?
First of all, we would read this as more of a timeout rather than a real fall, a tactical pause, really to give some breathing room to both sides potentially, and as the Chinese would say, to exchange some space, some time for space. Meanwhile, China is gearing up for this medium-term preparation. It is buying time to reorganize supply chains. We've seen that actually exports held up relatively well as they directed their trade and goods to Latin America and Southeast Asia. Chinese companies are already on a very intense drive to diversify, to reorganize their supply chains. Lots of innovation going on. Small merchants have totally used digital trade and all sorts of innovation using the China Rail Europe Rail Expressway to reduce logistic costs, and they've really started to diversify and innovate. And so China's strategy is, look, they can't make further concessions because they need to look strong in front of Trump. That's how they're going to hold their power on negotiation table. But they're planning for strategic, longer-term reorientation.
Well, Jill, our reporter before you, was just discussing some of the touch points there. Things like chips, things like buying oil, buying soybeans from the United States. How much of the relationship and the framework between the first Trump administration and China may reemerge as the playbook this time around?
The first trade war or trade tariff spat really teaches us a lot of things, but we have to understand that this time around, the size of the tariffs are much bigger. The scope of the tariffs are much broader. Last time around, U.S. intermediaries like Walmart did absorb quite a bit of the tariffs, and the Chinese RMB depreciated by 9%, so very little was felt. But what was also clear was that the biggest importing sources from the U.S., Mexico, Europe, Canada, actually also were importing a lot from Chinese goods. So the goods that were ending up in the U.S. still embodied a lot of Chinese inputs. This means that this interdependence is very strong, and it's very, very, really hard to decouple. And the trade costs, of course, are rising with the supply chains moving to Vietnam, Thailand, and Mexico. It doesn't fundamentally solve the problem. And we've seen since 2018, the Chinese companies have gone on a frenzy of globalization. Has really pushed them outside of the domestic market. And of course, Chinese companies are in survival mode. They're very resilient. They're very adaptive. The same cannot be said about U.S. companies. And the pass-through of tariffs onto prices this time is predictably going to be more important.
Okay, good morning, it's Guy. What do you make of the latest Chinese announcement relating to H20 chips and the fact that they should not be used? What is the impact of that? What is the reasoning behind that? Where does that take us?
First of all, more broadly speaking, these export controls, these tactics to really stop China's semiconductors rise and develop have pretty much not been working. Instead, it has backfired. Since 2018, it's really pushed the China to do a full country, whole of a nation mobilization as if they're reaping Olympic gold medals. All the resources are poured in, state-directed research and development funds, the companies from the big techs everywhere pushing for this technological innovation, and it's working. You've seen that. So I think the latest news have also indicated that actually domestic capacity is now sufficient to substitute for H20 chips. That's actually when China says, okay, well, you guys can use the domestic ones. We don't need them. And that's why the opening up the markets has become more smooth. And second of all, these controls only bite if coalition hold, right? You need the Netherlands, Japan, Korea all to be in the same camp with the U.S., and we're not really seeing that.
Do you think the export tax that has been effectively applied by the White House to Nvidia, to AMD, kind of feeds that narrative that actually what this is ultimately going to end up doing is splitting the Allies apart on the issue of export controls?
Well, absolutely. Look, China represents potentially a strategic threat to Western Europe, but it also is one of the largest markets for them. So they always have to constantly balance between economic opportunity and security. Meanwhile, it doesn't really help if the U.S. is paying them in kind with big tariffs. It does not really motivate Japan and these countries to stay in the U.S. camp.
Hi, KU. It's Valerie in London. I want to ask a question about the recent moves from China to tackle overcapacity. We know that's something that the EU's von der Leyen has spoken out against. Also, the U.S. is very much against this overcapacity of goods around the world coming out of China. They've recently done some action on lithium, spoken about something about iron ore. How are you reading those recent moves by the Chinese?
Well, certainly the Chinese government is very serious about trying to cut down overcapacity and trying to prevent this price war that is hurting massively the domestic market companies and so forth. But really all comes down to the implementation and details. They really have to change the entire market organization. They have to really reduce the political economy aspect of it, which is the mayors, the city governments funding and fueling these companies with resources. They have to change that. So while the direction is right, the implementation is not quite there. So we're not sure when we're going to see the actual results.
And Kay, the other global phenomenon that maybe China has a role in is this U.S.-Russia talks happening in Alaska about the Ukraine war. Do we expect China to be vocal about any end to the Ukraine war?
First of all, I think China's internal challenge currently is a lot around economics. And one thing to point out is I highly doubt that in the trade war negotiations, China will throw in or agree to making some concessions that will have to do with energy security, energy purchases, and geopolitical issues or political issues in general. They see this as completely separate and want the U.S. to respect that. This is really based on mutual commerce and nothing else. So I don't predict them making, a lot of strong statements around this.
OK, going to leave it there. Thank you very much indeed, KU, for your analysis. A story that's certainly very much front and centre this morning. KU Jin, global economist and professor of finance at the London School of Economics and the author of the new China Playbook. Thank you very much indeed. Coming up, we're going to talk about the stocks that we're going to be watching into the open. BVA is certainly one of those. It's decided not to withdraw its takeover offer for Sabadell, despite investor backing for the rival's decision to sell its UK unit TSB. We're going to talk about that. We're going to talk about the defence stocks. We're going to talk about some of these chip stocks. All of that could be very relevant at the open this morning. We are 16 minutes away. This is Bloomberg.
Welcome back to the opening trade. Just about over 12 minutes back to when we start to open these markets. And one of the key questions that we have is that we are about 3 days away from the summit over in Alaska. About 12 minutes away from testing a major thesis here, which is simply whether the developments around the ceasefire between the Ukraine and Russia, or even the negotiations around it, are something defense stocks need to be thinking about when you're seeing that unwind. I wanted to take it a little bit step further and look at it from a cross-asset perspective, because over in the States, when you look at the bid into tech, sometimes from international investors, it is actually correlated to the dollar. Not in recent history, but certainly when you start to see that pullback for tech stocks, you do start to see a bid into the dollar to get into the tech stocks. I tried to see if we could see some sort of relationship and whether or not that applies into Europe as well when it comes to the defense stocks and the euro. And the truth is that relationship did exist, but is very much fading. I want to take you back into history here because this top line really shows the defense sector specifically. That's the white line. It's the index of some of your juiciest defense names, Rheinmetall, BAE Systems, you name it, it's in there. The blue line is euro dollar, and you can go right back to when the onset of the war in Ukraine began, and that correlation right here spiked to 0.8%, and it's kind of been there for, I want to say, the last couple of years until now. And now you're starting to see that correlation, even though on the surface it looks identical, it looks like they're moving in tandem, it is starting to break down a little bit. And I think, Guy, that's a really interesting piece of this trade, which is that ultimately, if you start to see these defense valuations in the equity market come back down, pull back, whether it's sales, whether it's a different focus, whether it's a recession, whatever the cause may be, even a ceasefire agreement potentially in Alaska as the best case scenario from a geopolitical perspective, does that ultimately show up in the euro? And Guy, according to this chart, I'm not so sure.
It's going to be interesting to watch what the flow picture looks like on that trade. It's certainly been one of the dominant themes of this year thus far. Let's talk about what else we're going to be watching. We're going to be watching the defence stocks very, very carefully shortly at the open. We're also going to be watching the CPI print out of the United States very, very carefully a little bit later on. The bond market will wake up for that. I promise, Val, that will be happening. Let's talk to our Markets Live executive editor, Mark Cudmore, about this print. Mark, does CPI matter?
CPI really matters today. As you know, Guy, I quite often provide context that shouldn't read too much into one print. But I think if CPI clearly beats today, and it doesn't necessarily matter whether that comes through the headline or the core, but if the set of data is overall clearly strong, I think it can really wreak havoc in markets. I think it disrupts both stocks and bonds, and that's because it'll simultaneously disrupt two important narratives at the moment in markets. One is it'll kind of hinder the Fed dovish pivot, which is priced in aggressively. So suddenly it'll make it harder for those cuts to come. It'll kind of raise up the stagflation threat. And with that, it'll also increase scrutiny on the US fiscal outlook, which has quietened down in the last couple of months, and correctly so. In June, we were getting really worried about the US fiscal outlook prematurely. And as we talked about at the time, auctions were actually going okay. We didn't have the fiscal deal pass. We didn't have tariffs come through to inflation yet. Well, now the situation has changed. Last week, auctions were poor. Now we're seeing the fiscal measures actually come through in terms of concrete move changes in the US debt burden in terms of their expected payments over the next year. And we might be about to see tariffs really feed through to inflation as well. So all the factors that were driving a bullish view in treasuries 2 months ago have changed to be bearish. So I think that if we get a high print today, we see treasuries sell off right across the curve, we see stocks lower, and we see a knee-jerk reaction for dollar strength.
But Mark, put a number on this for me. What number on core CPI would really start to doubt that September Fed cut? Would it have to be higher than a 0.4?
No, it doesn't have to be higher than a 0.4. I think that the whisper number is that if we get a miss from the Bloomberg consensus today, it'll be a slightly higher print than a slightly lower. That is true. But still, if confirmed, it's a problem. So it's right that we're at the higher end of those expectations. But I think that if we get, let's just say, a number that where the prints are roughly in line, but one or two of them is just 0.1 above expectations, that'll be enough to cause problems. Now, that might be a less strong reaction, but that will still see bonds sell off and stocks sell off from here. The price action in stocks was not good yesterday, and we have to know that US Treasury yields, the long end, have been rising very, very slowly the last 5 days in very, very quiet markets because all the fundamental drivers for Treasury strength are now behind us.
Mark, what does that do to the bond market? I'm looking at 428 on the 10-year yield. Give us a range.
Look, I think 10-year yields are going to rise substantially from here into year end. I mean, year-end's a bit of an arbitrary date. Maybe it goes into next year. But I think the multi-year highs in Treasury yields are going to be tested again over the coming 6 months, coming year. I think that the narrative of the bond market facing a reckoning, which Jeffrey Gundlach said back in June, and I pushed back against at the time, is now valid. It's now the time to play that theme, but for the coming 6 months or so. So you're going to see 10-year yields significantly higher over the coming months.
All right, Bloomberg's Markets Live executive editor Mark Cudmore joining the program this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start today with some key Nvidia suppliers after China told local companies to avoid using Nvidia chips, especially for government-related purposes. So we should keep an eye on companies like Siltronic, which makes wafers for Nvidia, BE Semiconductors, and Schneider Electric, which is more in that electrical equipment side of things. They've all been having a bit of a tough year, and there could be a knock-on effect if Nvidia loses that part of that Chinese revenue. Moving on to Spain, where BBVA is not letting go of Sabadell just yet. It said that it was maintaining its takeover offer, even despite the fact that Sabadell is now selling its UK unit TSB. Sabadell has been actually outperforming a little bit of BBVA. The gap was a bit wider. It's now narrowed a little bit. And Sabadell is also a bit of an investor and analyst favorite. We have got 0 sales on the stock, 12/7 holds. So we'll see how much that picture changes at the open for the Spanish banks. And then finally, let's talk a bit more about Rio Tinto after Trump said that gold will not be subject to tariffs. That might be providing a bit of a boost this morning for Rio Tinto. After a little bit of weakness, we are down about 3%. The caveat being that, of course, this was a social media post, not an official policy. So let's take it with a bit of a grain of salt as well.
All right, thanks to our equities reporter, Chloe Melly there, running through some stocks for us to watch at the open. I guess maybe want to add one more theme around the U.S.-Russia talks happening in Alaska. We're all very interested on how European defense stocks are going to act after their 2-day slump.
OK, so let's kind of segment this out. Defense stocks are going to be really interesting at the open. What happens there? Trump downplaying expectations for this meeting in Alaska. Do we buy defense stocks on the back of that? They've seen a significant dip over the last few days. What happens with chip stocks this morning? Is that a negative? How does that play out in terms of the European story as well? That's going to be fascinating to watch. Then we just, do you want to play this morning with CPI coming? Like, do you just sit back, rock back, sit back, enjoy yourself, watch the show, and wait for that number to drop a little bit later on? There's various trades you can make this morning. We're going to find out very shortly what is happening. The opening trade is now 5 minutes away. We'll count you down to that. As you can see at the moment, not exactly the most exciting of opens, but we'll get things going in just a moment. This is Bloomberg. Tuesday the 12th, good morning. Fascinating session about to arrive here in Europe. What do you do today? Do you wait for the CPI number a little bit later on? Do you trade the defense narrative? We're going to be watching that carefully as Trump downplays the expectations around the Alaska meeting. What happens with chips? How does that feed through into Europe? All of that still to come. Let's talk about yesterday and figure out the negative price action that Mark Cudmore was just talking about. You could see it here. The fade in the United States yesterday afternoon into the close in advance of the CPI number. How does that set us up for the day? That's going to be an interesting trade that you need to factor in as well. Europe closed here. There's a little bit of negativity, therefore, you could argue, into that price action this morning for Europe. But we're not necessarily seeing that in futures. Looks like a fairly flat open this morning here in Europe, Val.
Hey, it's looking pretty green. Don't downplay it. We're up 0.25% on the Eurostoxx 50 futures. I'll take that kind of gain. 50-100 futures are lagging just slightly behind, just up 0.1%, and DAX futures up 0.3%. Kriti, what stocks are on our radar for the open?
Well, of course, we're going to test that theory of whether or not the defense momentum to the downside or the upside continues its trend. You mentioned the DAX, of course, as it to kind of show up to the index level as well. Got one eye on chips as well. I mean, look, the defense sector is really tied to the idea of some sort of trade truce between Russia and Ukraine. But the chip story is also very much a geopolitical one between the United States and China, especially as China puts out these letters, at least is now being reported. They've done this about a month ago, puts out these letters discouraging use of the H20 chip. So we're going to see how that all shakes out for the likes of ASML and company. Miners as well, very much on our radar. We've got a gold tariff story to factor in, Guy, plus some moves in iron ore, some of the other metals. We'll see how it shakes out at the open.
OK, all of that to come. Let's get you to this market open. The Tuesday open is upon us. It is time for the opening trade. Let's figure out exactly what Europe is doing, what all those managers out there are seeing in these markets this morning. The FTSE 100 flat out of the open. We'll see how the miners trade in just a moment. We'll get a tell on what is happening there. You've got the gold trade, you've got the iron ore trade to fold into that narrative as well. We're going to watch and see exactly how some of the chip numbers perform in Europe as well this morning. We'll see how they perform. Critically, I think as well, we want to watch what is happening with the defence names. names. All of that needs to be factored into the DAX in particular this morning, but the FTSE 100 as well. Names like BAE Systems, an early tell maybe on what the sentiment is surrounding this sector that has been dinged up pretty well over the last few days. The CAC is open. It's up by 0.4%. Maybe we were underestimating this open a little bit better, up 0.4%. The DAX is open as well, up by 0.3%. The IBEX by 0.3%. So as Val says, not a bad open. We'll take a little bit of positivity first thing this morning, but where is it showing up, Valerie? Which sector story are we watching carefully this morning?
Well, nearly all sectors are in the red. There's only one, all sectors in the green. There's only one that's in the red, and that is technology. So it does seem to be there is a negative read-through from these European chip makers on this China news that they are basically speaking very negatively about Nvidia's H20 chip. But when it comes to the sectors that are performing very well, basic resources is at the top of the basket, Kriti. That's due to the rise in iron ore prices, which is extended into a second session. So that is definitely helping out the basic resources types of names. I'm not seeing defense stocks jumping out at me at the moment. I'll have to dig into there deeper, but we are seeing Vestas Wind Systems, one of the best performing stocks. I think that's interesting because yesterday we had the Danish wind company Ørsted drop some 30% after announcing that rights issue, essentially getting a bailout by the Danish government, who owns 50% of the company. So it does seem like to be that alternative energy at least is having a bit of a bounce back after yesterday's quite gigantic slide in Ørsted.
I'll mention the defense names here now that we're getting a little bit of a read. I'm looking at Saab here, higher by about 1.2%. Rheinmetall, though, also bouncing back, higher by about 1%. So, again, not a massive jump into defense stocks this morning, but certainly one that I think tests our theory that we've had around this table, which is that the defense story, the defense unwind, is very much related to the ceasefire talks. It's not just a valuation story, as we were suspecting from last week's trade.
If you look at the points gains that are coming through this morning, Rheinmetall is the second biggest points gain in Europe in terms of the upside for the stock 600, and you're seeing that with some of the other defence names as well. I guess we could lump Airbus maybe into that story as well, but you do have some of the other defence names moving too. It is the chips names that are acting as the drag this morning, so technology is under pressure. In terms of points, we're talking here, this is not percentage. SAP, ASML, two of the biggest drops that we're seeing first thing this morning. We are also seeing some of the pharma names actually under pressure, which is interesting too. So you've got names like Roche, Astra, GSK, or all under a little bit of pressure. So that's where the negativity is coming through this morning. So we do see some bounce back in luxury. You've got some bounce back in some of the defence names as well. And energy picking up a little bit as well, which I think is interesting. How would you... Is that part of the Russia trade? I don't know.
I think it's more down to the Ørsted slide yesterday and rebounding after that, because we are seeing a lot of the more alternative energy names trade strongly. The more traditional ones like BP are trading flat this morning.
Yeah, Shell's up by 0.4%.
Yeah,
like it's adding to the upside, but not by much.
We got to mention the luxury names as well. Hermes and LVMH are moving the entire benchmark up, and that has nothing to do with France. It has nothing to do with Cristiano Ronaldo's engagement, which I think is important. Just saying.
Tell me more, Kriti.
I would love to. It has to do with the U.S.-China trade truce. Maybe at the end of the show we'll give it a minute. But I think it's another crucial one because it is moving the benchmark as a whole to the upside.
All right, well, let's bring all this to our markets guest sitting around the table. Christian, I had no idea he was engaged. Tell me more, Kriti. I'm really interested. Joining us now is Lucy Baldwin to discuss these market topics, Global Head of Research at Citi. Obviously, one topic we didn't talk about there is CPI. Big data print today. And I know we were talking about before whether this reallocation trade into Europe with U.S. stocks lagging is something that could potentially come to an end, given the U.S. has had such a great earnings season, especially when it comes to those tech names.
Yeah, it's very topical at the moment. As you say, a lot of emphasis today on what's going to happen with the CPI print. I think, as we know, the Fed has a bit of a tightrope to walk here. If that print today, from the CPI perspective, given obviously the read-through into PCE, ultimately is too strong, if it's too hot, everybody's going to be very nervous that if you get more inflation coming through earlier than expected from tariffs, that could be seen further in furniture, toys, all those sorts of imported products into the US, then that's going to put the Fed in a bit of a bind. They're not going to be able to put through, we're expecting 3 cuts, the market's expecting at least 2 this year. And I think if you can't get those cuts through, that's not great news for equities. Similarly, of course, if we go the other way and we end up, as we go through over the course of the next few weeks, getting poor data in terms of underlying health of the labour market, which obviously we were all very nervous about given the revisions in the recent payrolls report, then I think that is also clearly going to be problematic, because although you might then see a lot more cuts than the 2 or 3 that we and others are looking for, that's not a great read on the health of the US economy. And I do think that is going to be a massive debate as we go into next year. I know there's other economists out there away from us. Some are suggesting that you could be in a sort of debate about a recession next year for the US, right, given we've managed to sort of hold it off in many ways. And then there's others out there saying very clearly it's going to be a very stimulative year next year from a fiscal perspective with one big beautiful bill. And that's going to be a credit cycle. It's going to go gangbusters. And i.e., if the Fed don't get the cuts in now, they won't get them in next year. So there's a massive debate, I think, about the health of the US economy into next year, and therefore the read into markets. We're still risk on in US equities. And as you suggested, this earnings season has been incredibly strong, like particularly driven by the tech names, right? We came into Q2, most people had 5% expected US earnings growth, and it's probably going to be more like 11%. I know we haven't totally finished. We've got people like Nvidia to report at the end of August. But ultimately, it's been a much stronger earnings season. We and others are raising the expectation for this year. So we've just raised again our S&P price target for the end of the year. And, you know, it's on the back of strong fundamentals, which is what gives a lot of conviction that it's resilience rather than any kind of irrational exuberance in the US.
All right, Lucy, you sound quite bullish on the AI trade, at least, and US markets generally. Are you laughing at her bullish sentiment?
Yeah, I'd love to get your reaction to the bullish sentiment.
Very welcomed. But is there any, I guess, risks on the horizon for this AI trade? A lot of people have talked about this ginormous capex spending that they've begun or have continued to do. Where do you start to see red flags? What would start to change your mind about the AI trade?
Yeah, and I think, you know, again, as you say, right, at the moment it is essentially underpinned with great earnings expectations. So again, like second quarter, a lot of it was driven by Mag 7 in terms of where we saw strong numbers, where we've seen the upgrades. You know, we're now expecting around 11% earnings growth for the full year in the US, and half of that is Mag 7, right? So again, we've kind of gone back to the dominant group of tech names rather than the sort of broadening thesis that many of us, including many of our investor fund manager clients, had been expecting / hoping to see, and we've come back to that. I think there's a lot of risks in terms of obviously the returns on that capex on a multi-year view. But ultimately, AI is going to be probably a decade-long story, and we are pretty excited about what it might mean in terms of the health of the overall earnings picture across the US market. I think, you know, you were asking me earlier about Europe, right? And again, I think if I had our European tech analyst sat here next to me, he would be saying, look, without the sort of AI trade coming to save us all, I would have a pretty lackluster sector, right, with a lot of product, a lot of inventory waiting to sell it through, industrial cycle not super strong, and there would be many more concerns and overhangs, right, in terms of, you know, the underlying health of the sector if you could kind of strip that out. And that's sort of how I would frame it, right?
What multiple on the S&P would make you uncomfortable?
Look, I think, guys, you and I have talked about before, like, valuation is not great in terms of predicting the next sort of 6 to 12 months performance. It's better at predicting the next 10 years. I mean, I agree with you. When you're at 23 times earnings or in that ballpark, you're right up there, right, versus history. And I think what's interesting is it's very difficult to build a case that it should be trading on much more, right, which is why it has to be earnings doing all the legwork and giving you all the upside from here. I think what's interesting is once you get under the hood, there's an awful lot of dispersion there in the market. And a lot of those smaller companies are actually not kind of at their 52-week highs, right? And a lot of those names are struggling a little bit more. And that's where you're seeing things like the impact of tariffs come through already and start to squeeze margins, right? We've had this big debate about who's going to bear the tariff brunt. Is it the consumer, which is obviously not great for GDP, or is it going to be corporates? Are they going to have to take the hit because they can't pass the cost on?
Lucy, we are 3 days away from a summit in Alaska between Donald Trump and Vladimir Putin. We've tested the theory of whether or not that's something that's getting priced into defense stocks that saw quite the unwind last week. It kind of seems to be. Play the hypothetical for us here. Is a ceasefire agreement or progress towards one, is that a win for European stocks as kind of a removal of the geopolitical overhang, or is this a negative given that defense is such a big piece of it?
Yeah, I think so. Clearly, obviously the big picture from an energy perspective would be if you could get a ceasefire, you could see some movement in terms of lower energy costs, and all of those things would be hugely positive, right? And obviously we could talk there about manufacturing or the impact on sectors like travel and leisure and chemicals that are super exposed. So there's some positives in that sense. I think what I would say is obviously there's an awful lot that's got to play out in terms of this potential for a ceasefire, given it's about territory, but it's also about the security deal and the backstop Ukraine's going to get. So I don't think this feels like it's going to be a sort of quick resolution. I think this linked to other things is a multi-year journey for defence, right? And there's the broader geopolitical landscape. I think what I would say is that when we talk to clients, what's really evident is there's an awful lot of longer-term money managers out there who have only relatively recently started to be able to buy the defence names, right, literally within the last few months. And so I think there is demand on a long-term structural basis to see that interest back in the defence sector. And I say that because of, obviously, some of what we would term like the ESG sustainability constraints.
So Guy asked you what valuation would make you uncomfortable with the S&P. What valuation would make you uncomfortable with defence stocks?
I think, again, you have to look at it in the framing of, like, growth returns and at a sort of sector level, right? Again, I think, you know, I suppose to nail Guy's question a bit more fully, right, I think we're sort of there in valuation terms. It can't go much further. I don't think, again, with the defence names from a multiple perspective, you know, you have to see this earnings growth on a multi-year journey. I think the broader, bigger debate for that sector, ultimately, is what is that growth rate? And I think the things that have really made people question it is when you see some of the technology at relatively low price points that is more sort of like drone, etc., more kind of like AI-driven tech, doing more of the heavy lifting in some of these hot wars around the world, whether that's Russia or Ukraine or in other places. And I think that is clearly what is making people think, is it all about just the big name defence stocks, or is that growth going to ultimately slow and get replaced by a different type of defence growth over the course of the next, 5 years or so?
Lucy, great to see you. Thanks for stopping by. Nice and bullish. Lizzie Baldwin, Global Head of Research, joining us from Citi. Let's talk about some of the single stocks we're watching so carefully this morning. This is what the Core 6 looks like first thing this Tuesday. As you can see, a fairly mixed picture. You've actually got some of the pharma names. Actually, the pharma names are generally down. Novo's on that list as well. ASML is also giving back some ground. The chip space under a little bit of pressure. Luxury is up, maybe on the extension of the tariff deal with China. One name that is not on that list is Vestas. That stock has been climbing this morning. It's off its earlier peak, but up on the fact that it looks like it's won some orders over in the United States. So this looks like an issue that is related to Vestas rather than it being a holdover from Ørsted yesterday. We're going to have the company on set a little bit later on this week. Looking forward to that. So we'll come back to that story in just a moment and show you some numbers. Elsewhere, we've just been talking about it with Lucy. Let's talk about some of the defence names. Chloe's here with all the details.
Good morning. So, yeah, let's start with defence. Yesterday, we saw defence names go down on news of potential truce, and today, because Trump downplayed the expectations for his meeting with Putin over the end of the Ukraine war, we see some upward movements across that defence sector. Hensoldt, Rheinmetall and BAE Systems are all up a little bit, not massively, but a little bit. Moving on to Rio Tinto, the miner is also up this morning, up 1.25% on the back of Trump saying that there will be no tariffs on gold. So it's driving up this miner today. Moving on to another sector that is also moving on Trump news is the luxury sector. So MS and Kering are also up because Trump extended a pause on tariffs on Chinese goods for another 90 days. So that is providing a little bit of relief across that sector. Again, not massive moves, but a little bit in the green as well. And then finally, finishing on Sartorius, we've got an upgrade there from Jefferies, upgraded to buy, and that is getting the stock to rise. Almost up 4% this morning there for Sartorius.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. Coming up, we come right back to the tech story. China has urged local companies to avoid using Nvidia's H20 processors. We'll dive more into the details and the ripple effect next. Stick with us. This is Bloomberg. Welcome back to the opening trade. Just about 18 minutes into today's session. Green on the screen across the board, but all that excitement in the DAX futures that we saw completely paired its game. We're now flat on that index, but the CAC 40 seems to be picking up momentum. A lot of that seems to be perhaps a read-through from some of the luxury names reacting to that U.S.-China trade truce. But there's another component to the China story we need to be paying attention to, especially when it comes to the tech component. China has urged local companies to avoid using Nvidia's H20 processors, particularly for government-related purposes. Bloomberg Technology co-host Ed Ludlow hot-footed it over here from San Francisco just to tell us what's going on.
Sure.
This is something that predated the 15% revenue story. Walk us through the significance of this. Is there a viable alternative to Nvidia's H20?
In recent weeks, so you're right, it predates the last 24 hours of news flow. Various watchdogs and regulators in China have sent advisories. It's just guidance. It's non-binding. It includes a number of chips, but sources confirm specifically the H20, which is completely in line with what China does in technology anyway. It's very normal for watchdogs to say to a government-backed enterprise or even just a government entity, don't use foreign technology where there's a security concern. But your question is the right one. Right now, H20 is the only chip that Nvidia will be allowed to sell into the Chinese market. But it is not the only chip that's available to Chinese technology companies. Huawei, their domestic champion, has various generations of chip that are not just better than H20, they're better than H200, which until very recently was Nvidia's cutting-edge chip. So there's a national security element from China's perspective, but there's also actually, there was an opportunity here for our national champion to take some market share in the vacuum. Why would we now want Nvidia to be allowed to come back into that market? Especially if its tech is obsolete for the purposes of what's available.
Could this show up in Nvidia's numbers?
Yeah, so I'd imagine that on the sell side, there's a bit of a scramble this morning somewhere in the East Coast to start to remodel, because when the revenue split story came out, the simple arrangement being a quid pro quo where if the US government allows Nvidia and AMD to sell to China, they take 15% cut. And that gave a lot of confidence that even as soon as the next fiscal quarter, it would start showing up. Actually, Nvidia was very clear. We haven't sent any H20s to China, so that might have been a bit premature. But this would signal, and indeed, there's quite a few notes out already, that in the context of trade talks between the US and China, there's an issue here. And Nvidia is quite clearly willing to play by the president's rules. And one point I'd make very quickly is Nvidia always says that it's an American company and it plays by American rules.
Well, I guess the relationship with President Trump is really key in that relationship. And we did hear from Trump yesterday saying that he was open to Nvidia selling a scaled-back version of the Blackwell chip. This is their most advanced AI chip. Do you think that's something that's viable? Is that something that Jensen Huang has begun already to develop?
It's something that Nvidia has never discussed, on the record at least. Good spot. It was a critically important moment because the president showed command of technology. He understands that actually the market has really wanted Nvidia to talk about a new chip for the Chinese market. So whatever the future of H20, the idea was on a completely different architecture, Nvidia would do a new chip from the ground up for the Chinese market that would be more performant than H20, but not as good as the cutting-edge Blackwell chip. They've never discussed it. The market has speculated it is called B30. Indeed, on the show, Bloomberg Tech and at Bloomberg events, we've had big investors come on and go, we want to know about the B30 as if it's real, but Nvidia's never commented. And the president, in summary, said, Jensen wants to come and talk to me about a sort of less powered variant of Blackwell, and the market paid close attention to that. But it, again, would be subject to the same issues we're discussing in the context of H20.
Well, Ed, talk to us about some of the other chips players, not just NVIDIA, but AMD as well, Micron, Intel, et cetera, that maybe don't all have that exposure to China, but are trying to invest heavily over in the States.
Oh, gosh. Well, in AI accelerators, GPUs are going to data centers. NVIDIA has 95% of the market, AMD has 5%, and everything else is negligible, so we can move on from that. You know, the context right now with Intel, particularly post-meeting between the CEO and the president yesterday, is that technology companies are zigging with the president, and today Intel's been zagging. You know, it's just not been doing the things that the administration is supportive of, which is ironic because on paper, Intel is America's domestic champion for manufacturing chips. There's been heavy emphasis on TSMC, Taiwan's company, and Samsung, Korea's, investing billions of dollars to ramp up capacity, particularly in Texas and Arizona. And Intel, hence the change in CEO recently from Pat Gelsinger to Lip-Bu Tan, you know, it just fell behind. It didn't execute. But the story with Lip Bhutan, last Thursday, the president posted on Truce Social he should be fired or he should resign because of historic links to China. Now it seems like they're moving forward together.
The Trump administration is really getting into the weeds on this stuff. The president's really getting into the weeds on this stuff, which I find incredible in so many ways. I still don't understand how you do the export tax effectively.
You're assuming I understand.
Well, I'm hoping you do. I'm assuming you know more than I do, which is usually a correct assumption.
It's kind.
Where does the IP sit? How do you tax this stuff if the IP's in, I don't know where it is, or the manufacturing's in Taiwan? Is this something that is viable?
The answer is we don't know, but you raise a good point. Well, hypothetically, where would this semiconductor be manufactured? You know, a tariff or a tax is applied typically at the point of entry or exit from the country. So what this 15% revenue split is being labelled as is an export tax, which is to some extent unprecedented. Is it unprecedented in the context of how Trump does deals and does business? Not necessarily. You know, he has done a number of ad hoc arrangements with different companies.
Yep.
Apple is one we can get into at a later date. But my understanding from a White House official I spoke to last night is that what the president said is true. Jensen Huang went to the president. I want to get an H20 export license. The president said 20%.
He said 15%.
Jensen said 15%. And they just cut a deal. My understanding is AMD was actually done a little bit more through the Commerce Department, but we don't know what happens next. That's part of the fun of covering technology.
Ed, and you do it very well. Thank you very much indeed for stopping by and seeing us here in London. Ed Ludlow, hot-footing it from San Francisco. The next edition of Bloomberg Tech Europe airs this week. The show will be exploring how AI is changing the way we work. 6:30 a.m. London time, Friday, with, there he is, Tom McKenzie. Let's talk a little bit about what we're getting out of Norway this morning. The Sovereign Wealth Fund enjoying its best quarter since 23, returning 6.4% in the second quarter, propelled by stock market gains. Kari Lundgren joins us very briefly to talk about this. Kari, just how did they make that? What was the return pickup and where did it come from?
Good morning, both of you. In general, it was European stocks. You have to remember that the wealth fund here is largely tracks the index with a little bit of margin. So they will follow what the stock market has done for the first half of the year. European stocks gained 17.8%. Financial firms gained 16.5%. And so, yes, and a big contributor was European banks. We will be finding out more, I should add, in the next few minutes because their holdings list just dropped. So we should be adding to that story shortly.
Kari, we look forward to your coverage there. We'll leave it at that point. We should just mention, of course, you've done a great job in terms of this coverage. Some of this currency impact is also going to be showing up, and we'll keep a very, very close eye on that as these start to unfold. We also are going to be hearing from the head of Norway's sovereign wealth fund, Nicolai Tangen, is going to be joining later this morning on the Bloomberg Brief. We imagine he has a lot to say when it comes to the defense narrative, when it comes to the tech narrative as well, which is one that permeates through this market, not to mention some of the concerns around tariffs and some of that growth risk.
Yeah, and they're being one of the largest holdings of Nvidia. I know we were just talking about Nvidia, their relationship with China, the relationship with President Trump, all that hinges on how they export this new technology, their new AI chips, into wider markets.
Okay. All of that still a firm focus as we work our way through the back half of this show. European stocks adding a little bit to the upside this morning. Coming up, we're going to turn back to the US CPI story. Grace Peters is going to be joining us, co-head of global investment strategy at JP Morgan Private Bank. That is all coming up at 26 minutes past the hour. This is Bloomberg.
Welcome back to the opening trade. About 30 minutes into today's session, we're starting to see how this market is shaping out. And I think it's interesting. On the surface, higher by 0.3%. But take a look at this index level. The outperformance is not coming from the DAX. It's not your defense name that's driving this market higher. It's your luxury names. And that's showing up from the CAC 40. Geopolitics still very much at the center, just not a conversation between the United States and Russia. It's a conversation, Guy, between the United States and China.
More stocks up than down. Markets having a slightly better day. You can probably take that away. 468 up right now. Just want to highlight the volume number. We are mid-August. The volume number is quite light this morning. Just bear that in mind. Maybe people are sitting out waiting for the CPI number to drop a little bit later. Not many 52-week lows today. There's plenty of 52-week highs in the banking sector, though. Let me just show you some of the names that we're watching and what we're seeing around Europe. You've got AP Muller-Maersk also hitting a 52-week high. The shorts that were in that stock certainly being burnt recently. ISS is trading higher as well. But the banks generally are where we are seeing the bulk of the 52-week highs. That's where the story has been for the bulk of this year as well. The banking sector has been the driver of European performance this year. Defence has been obviously there as well. But Banco Sabadell, obviously in the news on the M&A front as well. That stock is up by 1.7%, Val.
Here's what else you need to know this morning. The U.S. has extended a pause of tariffs on Chinese goods for another 90 days into early November, stabilizing trade ties between the two world's largest economies. Meanwhile, China has urged local companies to avoid using Nvidia's H20 processors, particularly for government-related purposes. And next, President Donald Trump is downplaying expectations for his upcoming meeting with Russian leader Vladimir Putin as he seeks to end the war in Ukraine. European leaders and Ukrainian President Zelensky will hold a call with Trump tomorrow ahead of the U.S. president's meeting on Friday. And lastly, Britain's jobs market appears to be past the worst of a £26 billion tax hike by the Labour government, with payrolls falling only 8,000 in July, the lowest drop since January. Kriti?
Valerie, thank you so much. And I think it's that kind of jobs data almost that is really keeping everyone on tenterhooks. Let's get a little bit more insight on that. Dan Hansen, chief UK economist over at Bloomberg Economics, joins us around the table. Dan, your initial reaction?
I think exactly what Val's just said, a little bit stronger than expected. I think the broad picture here is that we've got a jobs market that is loosening, and I think it's going to continue to loosen through the remainder of this year. I think what the data does today is raise a question about, are we perhaps reaching an inflection point around it? And I think that is what we heard from the Bank of England last week, where the jobs market, if you go back to June, the jobs market looked very weak. We had a big fall in payrolls. That got it revised away. And we're now in a world where the jobs market, it is loosening, but it's not loosening at a particularly rapid pace. And as I say, what Val just said there around the national insurance hike, I think there is this risk now that things stabilise, and the bank is very sensitive about inflation. We know that from what we heard last week. So I think if this trend continues, we're going to be asking questions about whether there's going to be a November cut, which at the moment is 50-50 in the market. Yeah. That pricing hasn't changed this morning, because I think this has sort of reaffirmed people's priors, this print. Yeah. But I think if you get more of this stabilisation...
Does the wage data could sort of speak to that as well? Like, wages are still, running at 5%, circa kind of around those sort of levels at the moment?
Yeah, it does. It does speak to that, but it's cooling. And if you look at year-end numbers, you're looking at sort of 3.5, 4, which is much closer to where they need to be. They need to be at about 3 for 2% inflation.
And where do we think inflation's going to be at the end of the year?
About 3.5.
Right.
So that's the challenge. And you've got food inflation that's high. To use the Bank of England's word, it's the salient bit of the basket that households look at. That affects their inflation expectations. But if you listen to Bailey in the press conference, he said wage growth is the biggest bit of news we've had since May. And we continue to track below their May forecast. And I think their August forecast looks about right for 3.5%, 3.6% by year end. So if you think there are 5 of them who are itching to cut rates. Yeah. At the moment, I still think they'll probably be in that camp. The one to watch is Bailey, because if he moves, then it's suddenly 5-4 the other way, and we're on hold.
Dan, I want to tie this into the broader narrative, because you can argue that Canada and the U.S. are both having the same issue, a labour market that's weakening, but inflation above target. Is there any hints that maybe the MPC would act differently than the Fed or the Bank of Canada in this, obviously, the dual mandate approach? Yes. I know not every central bank has a dual mandate, but is there any hint that the Bank of England would act differently?
I mean, I think if you look at it, if you took a step back and looked at all the different central banks, you'd probably say that the Bank of England is quite dovish, actually, given the inflation backdrop. The inflation backdrop is challenging in the UK. We haven't beaten inflation. Like, for example, Christine Lagarde uses that term. Mm-hmm. And in the US, of course, there are tariffs. It's a very obvious explanation for why inflation will be rising in the US. In the UK, it's not about tariffs, it's about taxes. And I think the problem, and the historical problem in the UK, is that inflation expectations are very sensitive to the inflation numbers. And if you look at averages of inflation in the UK versus the US, we do run above 2% on average in the UK. I think over the past 10 years, we've had big depreciations in sterling, obviously movements in oil prices. So we're used to slightly higher inflation here in the UK. And I think that actually speaks to being, if you were to be objective, being a slightly more hawkish central bank rather than a more dovish one. But the Bank of England is very, very keen at the moment, at least, to look through this inflation hump that we're going through in the UK.
Dan, thanks. Really appreciate it.
No problem.
Dan Hansen catching us up on the latest data out of the UK and how that folds into the wider picture. Joining us from Bloomberg Economics. Let's talk about the bigger picture here and what is happening. We've got the CPI print coming out of the United States a little bit later on. We need to fold that into our thinking as well. Joining us now, Grace Peters, co-head of Global Investment Strategy at JP Morgan Private Bank. Good morning.
Good morning.
The bond market is smelling a slowdown, and we're starting to see evidence of that. The equity market is, let's go. Everything looks good. Is there a difference there that I need to worry about? In a kind of balanced portfolio, as I think about how I should be investing right now, how should I be thinking about the world going forward from here? How are you thinking about the world, and what are your clients kind of asking you about that?
Yeah, I think, to me, there is a slowdown ahead. I don't think there's a recession ahead, but we're absolutely seeing growth slow.
Yep.
Inflation is going to rise. I think we're going to see a CPI print that's on the hot side today. That's certainly what the market's expecting. And I think that trend will continue through the end of the year before tailing back to around 2.5% next year.
Okay.
What I think is very important when it comes to equities or indeed credit markets, risk assets at large, is that I don't think that the market and the economy are in any way the same. When we think about corporate earnings season that we've just had second quarter for the US, we saw 10% earnings growth that followed 12% in the first quarter. All of this being at a time when we had lackluster GDP. You know, we now know downward revisions to the labour market. And so you're seeing very clearly this differentiation being drawn out between the market, which is driven by structural trends, predominantly artificial intelligence, and the economy that I think is going to see this more stagflationary backdrop in the second half of the year.
You don't see those converging. There's no kind of... The market can keep doing its own thing. The economy can keep doing its own thing.
I think the market will continue rising. I think there's obviously going to be bouts of equity markets, and I think corporate credit will continue to do well also. There's going to be bouts of volatility. Nothing moves in a straight line. But I think that the earnings backdrop and, of course, the balance sheets supporting those earnings and supporting the investments is pretty robust. So I think investors are going to continue to be surprised that the pain train broadly lies to the upside, and you're still going to get another 7 to 8% out of equities over the next 12 months, and probably 6% out of corporate credit as well.
All right. Sounds bullish to me. Grace, I want to ask you a question that you kind of touched on there, the difference between the equity market and the real economy. I was reading a piece in the Wall Street Journal by Greg Ip, that guy sent to me while he was on holiday, talking about how AI is just sucking in so much investment, almost to the depreciation of the real economy, maybe the more rate-sensitive sectors. Are you seeing that kind of narrative? Is that any credence to that kind of narrative, that AI can really just suck away growth from the rest of the economy?
No, I don't think it's going to suck away growth from the rest of the economy, but I definitely think that that is where CapEx is oriented at the moment. And actually, very interestingly, what we've just heard from companies through corporate earnings season is that the AI use cases, i.e. the productivity and the margin benefits, it's not just residing in the technology sector anymore. You're starting to see across sectors examples of productivity gains and actually margins across the market, talking predominantly to the US, positively surprised significantly, which I think is in part because of the AI benefits, also because companies are dealing very well with the tariffs situation. But AI and productivity gains is a huge part of that. So we do think there's a whole AI value chain. Yes, of course, it starts with technology, but the power needs that follow. And then within each sector, there'll be winners and losers. To us, it biases us very much towards large cap when it comes to public equities, because they're the ones with the balance sheets and the ability to invest. And I think in the smaller part of the market, that's where it does become closer to the real economy, and where I think margins will be more at risk and the ability to invest and harness AI will be more limited.
So are you penciling in the equity rally broadening out to other sectors outside of AI based on that view?
Yes, I mean, the equity rally has been reasonably narrow around technology, but let's not forget we've also had industrials, utilities and financial stocks also do very well, and this is not just a US story. So I'd say definitely broaden globally. We do think global diversification is the right way to invest. And yes, by sectors, but still with technology really being the forefront because of the earnings growth and also share buybacks, which we know are also a central theme when it comes to incremental buyers.
The share buybacks is such a crucial theme on the side of the Atlantic as well, especially in the banking sector. You made a key point when it comes to the U.S. resilience story. So much of that is these corporates absorbing the tariff pressure. Can European corporates absorb the tariff pressure the way that American corporates can?
I think it's going to be tougher in Europe to absorb those pressures, but I think you've already seen that below the surface of the market playing out, with some of the consumer-facing companies having had a very tough few months. And as you highlighted before, areas like the banks, which lean into the European domestic story, because the story in Europe is very different now. For many years, we've been talking about European exporters really being where the growth is in sectors, like luxury goods. And that has totally flipped, I think, since we've seen the German fiscal stimulus, where now the exciting story is in Europe is far more domestically focused, and that's why the banks can do well. Kriti, as you mentioned, also coupled with the share buyback story that supports European financials and potentially some consolidation potential later down the line as well.
You said that it's kind of been playing underneath the market as well. Why is that kind of margin compression not showing up in the stock price just yet?
Well, for when it comes to European companies, the valuation is so much less to begin with, and I think that when we think about in the US, it is showing up in the share price. If you look at earnings momentum, which is in part is driven by the market, you've seen small caps and consumer companies see negative earnings momentum into this quarterly earnings season, and technology and financial see positive earnings momentum. That's driven by margins, and that's reflected in the share prices. When it comes to the European businesses, then I think, look, we've seen ECB rate cuts, which is also helping sentiment and helping margins to some extent as well. And as I say, the valuation of European stocks and the fact that they are under-owned, and there's been a flow story predominantly around the dollar and positioning around dollar overweights that has also really helped European companies. So, we are still preferenced to the US. We think US exceptionalism is diminished, not destroyed, but Europe's still a key global allocation.
Do your clients like this market? Do they like investing in this market? Is it a market that makes them nervous? Are they comfortable with current multiples? I keep reading reports that humans are worried, that the machines aren't. And I'm just kind of wondering what feedback you're getting the other way in terms of... You talked about the pain trade just a moment ago.
Yes.
How much of a pain trade is this market rising?
So, our clients have held steady through the volatility that we saw in the spring and have been adding to the market since then. Adding to the market in a way that I think no one really feels comfortable, does it? This doesn't feel like a comfortable market. Indeed, our mid-year outlook was entitled Comfortably Uncomfortable for that very reason. But I think, look, our clients, we work very closely with them on having a plan for their wealth. Many of that, leads to the fact that they need to phase into markets. And therefore, dips are commonly opportunities to add. And so, when we think about the fundamental backdrop, we have been pretty constructive on the market over the last couple of years, always recommending phase-in plans, recommending to buy on pullbacks, and so I think, comfortably uncomfortable.
Okay. Comfortably uncomfortable. Kind of feels like every day around here. A lot of volatility and a lot of continuation of that volatility. It's interesting that people are still prepared to do that. Changing the mindset of this market, I think, is going to be something that takes
You look back
quite
in
a long
history,
time.
and there is always a reason not to buy the market.
Yeah.
And that's the equity market or just a 60-40 balanced portfolio. And yet, year after year, you get, price appreciation. And I think this is a well-trodden path with many of our clients.
As long as the elevator doesn't show up.
All right. Grace Peters, co-head of Global Investment Strategy over at JP Morgan Private Bank, walking us through those dynamics in these markets. We thank you so much. Coming up on the program, we're going to talk about the geopolitics a little bit, which very much is having an effect on these markets. President Trump downplaying expectations for a deal with Vladimir Putin, casting it as a, quote, feel-out meeting. Details coming up next. Stick with us. This is Bloomberg.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times, and I've been disappointed.
President Trump there downplaying expectations for his upcoming meeting with Vladimir Putin. We're joined now for more by Bloomberg's Greg Sullivan. Greg, this feels a little bit of like deja vu to me. Does it feel like deja vu to you?
There is an element of that. Obviously, here we have President Trump and President Putin about to meet in Alaska on Friday. Throughout Trump's second term, the first half of the year of that term, he has raised the prospect of a potential meeting between these two leaders. Suddenly, he's downplaying expectations for this meeting, and that's hardly surprising here. Trump, on the campaign trail and in the first half of his presidency, has been laser focused on the idea of a ceasefire, and it's unclear whether this meeting will actually produce that ceasefire, so he's sort of trying to manage expectations. That being said, the fact that these two leaders are meeting seems to indicate that there is potentially a way that a deal could be reached, or at least that they see the potential for making progress towards some sort of deal. So that is basically what Trump is trying to do here, is feel out, as he said in his words, what kind of alignment he might have with Putin.
Yeah.
Now, he has said that he's willing to walk away, however, if no deal is reached.
Greg, can Vladimir Putin separate US-Russia relations from Ukraine? Can we have like a kind of twin track here that relations between the two are not solely about this one subject? And would that be, I'm assuming that would be a win for Vladimir Putin if that's what he's looking for. Is that the objective here, to kind of start to change the narrative around the relationship between these two countries?
Well, in some respects, yes. Putin has long argued that this conflict in Ukraine should be settled between great powers like the U.S. and Russia. He has sought this one-on-one meeting. He believes that Ukrainian interests shouldn't necessarily be first and foremost in settling the war. He wanted this one-on-one meeting with Trump, which he is now getting, so that the great powers can sort of talk about what needs to be done and then mediate the conflict. Obviously, Ukraine doesn't see it that way. Europe is very concerned about that, but that's largely how the Kremlin has viewed it. So in that sense, they're very pleased with this upcoming meeting. Obviously, Trump has also hinted at potential separation, talking a lot about economic cooperation with Russia and trying to end the war. But again, he's campaigned on the ceasefire, so for him, that's still very much an element of this, even as he threatens to walk away if there's not a good deal.
Greg, great stuff. Thank you very much indeed for updating us as we count down to that meeting Friday. Let's talk about the other kind of geopolitical story we're watching. It kind of folds in tariffs, it folds in tech. There's lots of things kind of within this narrative. China urging local companies in China to avoid using Nvidia's H20 processors, particularly for government-related purposes. The move comes as President Trump signs an executive order extending the US tariff truce with China for 90 days. Let's talk to our trade czar about this. Brendan Murray joining us around the table. Let's start with the extension and kind of work our way into the tech from there. Is this the new normal? Is this just going to keep going and going and going? We keep rolling this over? Or are we now into the period within this next extension that we could see a meeting between Trump and Xi that could ultimately settle kind of what the narrative looks like on a more longer-term basis?
Yeah, I think the end game is a summit between Xi and Trump. But I think the big takeaway from the past 24 hours is that this trade dispute between the U.S. and China really boils down to two things, and that's critical minerals and critical technology. Yep. And both sides are trying to show that they're not reliant on the other. China, with this move on the Nvidia chips, saying, you know, we should rely more on local producers, sends a signal to the U.S. that you don't really have leverage over us. The U.S. has sent its signals that, China really needs to make sure it maintains the flow of magnets to the U.S. Otherwise, this truce that they've now extended could be destabilized. So I think it is the new normal, new abnormal, perhaps. It creates a lot of uncertainty that things can kind of turn south unexpectedly in detriment to the trade relationship between the world's two largest economies.
And Brendan, are you reading this latest move on China to tell local companies not to use Nvidia's H20 chip? Is this a way to get leverage in the next round of negotiations?
Yeah, I think it's Beijing trying to tell the U.S. that we really don't need you. We have domestic producers that can supply the chips that we need. Now, whether that's true or not, we don't really know. But we know that the Trump administration has given the green light to sell some of these less advanced chips to China, and is now collecting the 15% tax on those for that go to the U.S. Treasury. So there is a bit of give and take here between the two sides and these critical materials that both sides control. But it seems like we're going to kick this down the road another 3 months, and in the meantime, we'll have to see how other things like soybean purchases that President Trump tweeted about, how those play out in the course of those discussions.
I mean, there's a long list of some of those sticking points: rare earths, IP, chips, soybeans, as you mentioned. Not to mention, I think some of the visas and some of the foreign entrance questions as well. Brendan, is this the last kind of trade deal that we have to deal with when it comes to the negotiations with the United States? What else are we waiting for in terms of one that would have global ramifications?
Well, all of these deals that President Trump has signed or plans to sign, they're all still in flux. So it's difficult to look at the China situation and go, this is the last one that still needs to be done. We're still waiting on executive orders for the European Union deal, for South Korea, for Japan. All this uncertainty about sectoral tariffs is still out there, and it just shows you that these things are kind of with us for the medium term, rather than they'll be resolved, anytime soon.
You're going to be busy for a while.
Indeed. Bloomberg's Brendan Murray joining us around the table, walking us through that dynamic between China and the United States. Plenty going on in the next 24 hours. We got the German ZEW survey hitting the wires. Plenty of Fed speak, but I have to say the highlight of today has to be that CPI report. How much of the narrative does it change?
Is it going to, like, just to kind of bring it back to what Brendan's been talking about, are we going to see tariffs showing up? I think that's the question everybody's working their way through. The expectation is for a slightly higher print than maybe the survey number is suggesting. Kind of, how could this change market dynamics? Do I take 50 off if I get a strong print today in terms of the Fed cuts that we're expecting maybe come September? How strong would that number need to be to take a 25 basis point cut from the Fed off in September?
Yeah, and looking at those specific components that did show some tariff-induced inflation last time around, what if they reverse that today or don't show any more tariff-induced inflation that can play really strongly into the hands of the doves who argue that tariff is a one-time price increase? It's not going to continue. It's just going to show up in 1 month's print. So it'll be really interesting to see what kind of narrative comes out of that. I, for one, am going to be also focused on services. We know that services inflation makes up 75% of the CPI basket. So if we do get a surprise on services inflation, can really dwarf any of this tariff-induced inflation.
Can I just flag this NFIB day as well today? That number gives you that survey gives you a pretty good indication of actually what's happening in the real economy. If you want to know where tariffs are showing up as well, some of these small businesses maybe talk about that. They're going to talk about what's happening in the labour market as well. They're going to give you a guide. If we don't trust the data, the kind of the headline BLS data, what do we trust? Well, maybe some of these surveys are going to be quite interesting. What the ISM told us a few days ago in terms of the labour market and inflation, interesting. NFIB could provide maybe some of those clues as well. So watch that too. That's coming up later.
We haven't considered the possibility that there's no tariff read-through at all, as it has been for the last couple of months.
But that confuses the market even more, I think.
Well, exactly. It's unclear what that trade looks like. And I imagine on this August Wednesday, summer Wednesday, where it might just be a little bit more of the same, either calm or chaos in a couple of hours. Lots going on. That does it for the opening trade. The Pulse is up next. This is Bloomberg.